concise approach to top-down market strategies and the forces affecting investments. That's the spoken word on investing.
We're going to hear what that spoken word is right now on the stock market with our chief equity strategist, John Blank. Flew in purposely just to be here to give us that spoken word, right?
Happy holidays, Terry. Happy holidays.
Same to you. Let's talk about the stock market. It's been kind of interesting since the Fed raised interest rates. It's been a choppy market for the major indexes. It's been a sideways market, low volume, but that's expected because of the holiday season. But you can't help but ask the question, is the market losing some steam now?
Well, Terry, I put out a real-time insight poll about a week ago on whether or not this market finishes above 2250 in terms of the S&P 500. And I think that is where we're going to end up this year. I would be very surprised if we go above 2250. We're at 2260 when I came in this morning. And so I would look at 8-10 point drifting like you're talking about, pull back to that number over the next few days. Now, the question about this Santa Claus rally, which begins on this Friday and moves on from there,
right?
That idea is those 5-6 trading days from there and into the new year mark out whether January, the entire month of January, is strong. But what we need to think about here is all we need is a very small squeaker of a green number, and we'll have a decent January. And I expect that might be what happens here is we'll fade into Thursday, then rise up 6, 8, 10 points in the Santa Claus rally. I would expect this Santa Claus rally to be a stocking stuffer, not a Camaro.
All right. Let's just go back to the S&P for a moment. The 2250 is your target number for the end of the year. Right. Some people are eyeing up 2300. Is that a little too aggressive?
To me, it's too aggressive. I think you can look at 2300 by February or March, and I think you can get a 10% return off of 2250, which is 225, so 2475, 2500 is a benchmark for the 2017 number, and then back in, okay, if I can do 230 points over a 12-month period, that's about 20 points a month. So if I'm at 2250 in December, 2270 by January, 2290 by March, and so on.
All right. Another thing that kind of strikes me, maybe it strikes you as interesting as well, is that all of the recent geopolitical tensions that have erupted around the world, the attacks in Germany, Turkey, Switzerland that we just heard about a day or two ago, so far haven't really budged any of the world markets very much. So is this becoming second nature to the market now?
Yeah, terrorist attacks, unless they hit a prime minister, a House of Commons, and attack a government, tend to not be picked up by markets. So at this point in time, cross our fingers, that's all that happens. It's dreadful for those who are attacked, obviously, but from a financial market perspective, there's a callousness that has a callous that has developed over these things.
Yeah, that's interesting because there was a time way back where this kind of stuff would just cause huge swings.
Right. Now it's just a matter of like being more Israeli about it. We become more Israeli about it, where you understand that that's just part of the context of what you live, and therefore you absorb some of these hits as the process of living.
All right. Well, you're also looking for the Russell to correct. Is that a little bit of a bearish call?
A little bearish call. I mean, look, the Russell in January of this year was 1,000. It's 1,350 and change now. That's a 35% move. Now, is that too much? Well, 2 years ago, the Russell was 1,250. So the Russell, if you just draw a line from 1,250 to 13, that's about 10%, right? So there's been a real big rally this year, but not that big a rally going back a few years. It's really been a depressed market for the Russell. So my view is the Russell will probably go up to 1,500 here or even 1,600 over the next course of a year. I see that, but that is not a straight line given the 35% move up. Right? When you pull up that hard and that fast, it's going to leave a lot of people with money in their pockets that they're going to want to cash the Russell into for real cash or into some other rotation play or whatever. So it's likely to me, again, you're going to look for a 5% pullback and buy a dip on the Russell here in the next month or so.
All right. You're also looking for rates and currencies to tell their own story. What is that story?
Well, Terry, since Donald Trump got elected, there has been this consensus that interest rates are going to rise because there's going to be deficit spending, tax cuts, and infrastructure spending. And all this is going to lead to this fiscal stimulus, which has all these forms. But I really think the real thing the market believes in is these tax repatriations from abroad and corporate tax cuts and personal tax reformations that are going to drive spending. So the thing about that versus the fiscal ideas is that can happen, and that can happen fairly quickly, and that's being front-loaded into the market, and that also will create deficit spending, which will then fuel an interest rate hike on the long end. So a 100 basis point move in the 10-year in 6 months and a doubling has happened. And now we're at 2.6 on the 10-year. It's a 2.5-year high. Not as high as you'd think. Certainly the level we need to watch for bearishness is 3. But as long as we stay below that, we can still make a story up that the Trump trade has got some legs to it.
All right. Well, if what that old adage says is true, that the market looks ahead by 6 months, then this rally should be good at least for the first 6 months of the new year. Am I correct?
Yeah. Well, here's the thing. If you're looking out 6 months, you're looking out to June or July. There can be a lull in terms of legislative passage and implementation of any kind of decision making. So even with the excitement of a new presidency and the ability to move markets because they own the Senate and the House, the actual implementation and then the spending of that implementation could lead the market to pull back a bit before it rises again.
Okay.
So there is going to be leads and lags. It's going to have some volatility to it, even if you're bullish.
All right, let's talk sectors real quick here. You are looking at energy as very attractive, infotech as attractive, but the semiconductors, above all, remain red hot.
Right. So here's the thing. We got an OPEC deal in place. That was a September thing. No one thought it was going to happen. It did happen. So you want to look for an energy play. Williams Partners is a name I like. It's Zacks number 1. This company's got a really nice dividend, and this is the kind of thing you want to buy because you don't know when the inventory pull down will come from OPEC. They have a few months even when they're doing a production cut to work the inventory out. So you can earn that dividend and then wait for that stock to rise. In materials, or in infotech, I like Applied Materials, ticker AMAT. This is what I've learned about semiconductors. When they are red hot, it's like a grocery store of semiconductors. There's like 20 different types, right? So if you try to get too smart about semiconductors, you pick the radio frequency one or the one that goes in cameras or whatever. But the thing about an Applied Materials is what they are the platform for improving all semiconductor, applied materials for semiconductors, so improving the materials in semiconductors. So the platformlessness, the ability to work for all across them, can pick up the growth more securely. So these are stocks that I like a lot when you think harder about them, because you think, oh, I don't understand research or I'm not this business. No, just think about the idea that you're basically the guy supplying all the things in the grocery store to each one of the players. That's a smarter play from a stock investing perspective.
Okay, sounds good. Well, thanks for that. We will be checking in with you after the new year to see how this market is moving. In the meantime, don't forget that you can see more commentary on the markets written by John as well as other strategists here on our website, Zacks.com. You may want to check it out. Link to it all beginning on the homepage. With John Blank, I'm Terry Ruffalo.